Okay, dear students, we're going to end our discussion of insurance, the necessary evil, on a rather upbeat note. Because if we buy the correct life insurance, assuming we need life insurance in the first place, it turns out it's actually very affordable for those people for whom it makes sense. And we're going to see that in this presentation. Now, if you're looking at slide number 1, you see a quote from the wealthy barber. He's not the only person who described this phenomenon, this situation, David Chilton, but I think he did it the best. In a book that's 40, almost 40 years old, and so the numbers are all off, The Wealthy Barber, but it's still, the concepts in this book are timeless, and it's a very quick and easy read, and his jokes are worse than mine, which is hard to believe. But I saw him talk once. He's a very amiable, a very, 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 very nice fellow. He's from Canada. I don't know if he's retired or not, if you ever get a chance to. But do read The Wealthy Barber. Buy term and invest the difference. Now, you probably don't understand what that means, but by the end of our discussion together, we hope you do, because it could save you tens of thousands, hundreds of thousands of dollars over your lifetime. You don't believe me yet? Stick with us. Stick with us. Okay, what's an introduction to life insurance? What is life insurance? Well, I got some help from Professor Will Greenwald, who's a much more steeped in the world of insurance, and he set me straight on a few things, so I want to thank him for that. Life insurance is obtained by purchasing a contract, often called a policy, with the insurance company promising to pay a lump sum at the time of the insured's death, the person who is insured. Now, some of these policies will pay back premiums to the policyholder if the insured lives long enough. The policyholder and the insured person do not have to be the same person. They could be, they don't have to be. These types of contracts then also become a type of very bad savings vehicle for uninformed people. I used a much more saltier word for these individuals who are duped into buying these savings plans within life insurance policies. And we're going to discuss the two major types of policies in detail in this presentation. So be informed. Do not be uninformed. That's why you're here. The ramifications of choosing the wrong type of life insurance can be very hazardous to your financial health. Slide number 3. What is the purpose of life insurance? The purpose of life insurance is to protect someone who depends on you, the insured, from financial loss related to your death. Yeah, you don't buy life insurance for yourself. They're not going to bring you back to life. You buy home insurance, they rebuild your home if there's a fire. You buy car insurance if there's a crash. They get you a new car. They don't bring. You're not insuring your life in that they bring it back to life. No, it's for the people who depend upon you financially. There are some other reasons. If you want to make a charitable bequest upon your estate, okay. To leave as part of your estate, avoid estate taxes. Oh, no. Be very careful. There are certain ways that you can sort of skirt the estate taxes, assuming you have millions of dollars in your estate, in your net worth. Your growth worth. They don't care about the net worth. But the IRS often looks very unfavorably at some of these tactics. Again, it only affects very wealthy people, and they're usually promoted by insurance agents who should know better. The problem is you won't know whether or not your family got away with it, because you'll be dead when this thing happens. So be very careful. If you are in that enviable position of having to worry about the estate tax, and we'll discuss the estate tax at the very end of our journey together in chapter 16, you need to get some competent, honest, professional help both from lawyers, of course, and insurance agents, if you do need the insurance for insurance purposes, not to try to skirt the estate tax. And there are some policies that we talked about that have savings vehicles, and they will try to sell these to you when your child is born. And we call these the whole life policies for uninformed people. Yeah, for retirement, no, there's far better vehicles. There's a few individuals that we'll discuss later on that might benefit from a whole life policy. The savings vehicles inside the life insurance policy, but there's very few and far between, and we'll thwack the life insurance companies and industries uh, uh, mercilessly soon enough. Here again is from The Wealthy Barber. Again, David Chilton said it best, in my humble opinion. People should buy life insurance so that when they die, their assets combined with their insurance proceeds can allow for the proper winding down of their financial affairs and provide the desired standard of living for their dependents. Really, life insurance is better termed financial protection for dependents. That's my favorite. Okay, I know what I'm doing now. I'm protecting the people who depend upon me. Or income replacement insurance. Yeah, that's another good name, but I really wish life insurance were called financial protection for dependents, because that says what it should be doing. Why you should be buying life insurance. How does it work? What's the basis of life insurance? Well, there are these tables called mortality tables that provide odds on your dying based on your age, your sex, where you live, history of your family. Your premium is based on your life expectancy and the projections for the payouts for the persons who die. You're essentially betting the insurance company that you will die. It's a bet you hope you lose. But die prematurely. I mean, obviously, everyone's going to die, but you're essentially betting the insurance company that you will die prematurely, and it's a bet that you hope you lose, and so does the insurance company. And folks, they're not stupid. They have a very good idea of how many people will die, how many people will live within a certain population. The job is called an actuary, and if you love math, it's a great job, because we often call the life insurance companies the invisible bankers. And we learned that when you grow up, you want to be a bank, right? Well, when you grow up, you'd also like to be a life insurance company. How do we know banks and life insurance companies are making money? Their doors are open. So, yeah, I'm serious, folks. You tell these people about a little bit about yourself, and they'll give you a pretty good idea of how long you're going to live. So, on your own, play the longevity game. It's a little it's a little game where they ask you certain questions. Do you smoke? Do you do you exercise? What's your diet like? And the questions like that. And they'll ka-ching, ching, ching, and they'll tell you, up, you're going to live until 87. Or you're going to live until 92. It's very cute. Go ahead and play the longevity game. Slide number 6. There are two types of life insurance companies, and we really you're not going to remember this, obviously, after after the exam, after the class and stuff. But hopefully, if somebody offers you one of these policies and you say, "Oh, I remember Payano said something about this," there are stock life insurance companies, and that's the majority of them, that sell what are called non-participating policies. Um, the amount of the premium stays the same, and notice that most policies and most companies are stock life insurance companies, and most policies are non-participating. So you know how much you're going to pay. You're going to pay $500 a year for the 20 years that you have the insurance. The other type are mutual life insurance companies, which are actually like a credit union. They're owned by the policyholders. Notice that there are far fewer of these, and they've been dwindling in number over the last few decades. And they typically will sell you what is called a participating policy. And notice that far fewer, about 30% of policies sold in 2022, coming from the 2023 American Council of Life Insurance Fact Book, which unfortunately comes out in mid-November. So my apologies, we're not there yet. But here's what they do: they sell you a non-participating policy. I'm sorry. Yeah, they sell you a participating policy. I'm sorry, I'm getting confused. They sell you a participating policy with the premiums that may be higher. They might be $800 a year. Well, that doesn't make any sense. But why would I go with the participating policy? Because here's what the key is, and it depends on what population you're part of. Part of the premium is refunded to the policyholders annually. This is called a policy dividend. Now, don't confuse this with dividends that you get from stocks that we'll talk about later on. Those are taxable transactions that no. These are not. These are just basically refunds. That's what they should call them. They're simply not charging you what they said they were going to charge you. Now, why is this cool? Well, if you're in a group that tends to do well, living longevity wise, they will rebate maybe 70% or 80%. I had one of these because there's a company called TIAA, Teachers Insurance Annuity Association. It's been around for over 100 years, and they sold these participating policies, and the refunds were very generous, very generous. Now, what happens? And because the population is mostly teachers, and we teachers tend to live a long time because I think we give our stress to our students. You see, that's why we live a long time. We offload our stress to our students. I tell people, I am the luckiest guy in the world. I get to torture my students, and they pay me to do it. So if you find a participating policy from a mutual life insurance company, and you're in that group, such as teachers that tend to live longer than the norm, it might be a good deal. And that's the takeaway from these two slides that I apologize you're probably going to forget about. But remember, stock life insurance companies pay non-participating policies. They're going to give you a set amount, and you're going to pay that set amount. Mutual life insurance companies have participating policies that give you a refund. Now, what has happened is non-participating policies have gotten so cheap that the difference between the non-participating and the participating policy prices are very minimal. So it kind of makes sense now. If I were younger, a lot younger, and had children just growing up, I would probably choose a non-participating policy and be guaranteed that that's how much I was going to pay every year. Because if all of a sudden there were, let's not talk about it, but it happens, another pandemic, a tsunami, meteorite, disco, whatever, those policy refunds could all disappear, and you could wind up spending more per year. Okay, enough of that. Slide number 8. This is the important stuff to remember, folks. Do you need life insurance? Well, it's a very simple question. Are there any people who depend upon my income for their living expenses? And if the answer is yes, it's not a question of whether or not you need life insurance. You need life insurance 99.99% of the time. If the answer is no, you don't need life insurance. If no one depends upon you for their living expenses, you don't need life insurance, no matter what the life insurance agent says, because what are they going to do? They're going to try to sell you life insurance. Even if you're single, slide 9, you will be told by an insurance agent, of course you need life insurance. Your policy is acting as a savings vehicle. That doesn't sound good. Insurance is cheaper when you are younger, and you should buy insurance now while you are healthy and can get it. And your response to each of these should be nonsense, nonsense, and nonsense. Well, first one, definitely. We're going to discuss these savings vehicles inside life insurance policies, which the rate of return is abysmal. Yes, it's true that life insurance is cheaper when you're younger, but who cares? If you don't need it, why buy something? But it's cheaper. I'm going to buy it, but you don't need it. But it's more. And And you should buy insurance now while you're healthy and can get it. Now, there's a grain of truth to this. And usually what happens is people ignore the need to buy life insurance. Maybe they don't really understand the ramifications. Hey, I got 2 children, ages 2 and 4. I need life insurance. Well, I'm in good health. Well, what do I got to worry about? Well, 6, 8 years later, they're diagnosed with hepatitis B or cancer or whatever. Now, no insurance company is going to touch them, and it's too late. So it's very, very rare that people are turned down, and usually it's people that should have gotten their life insurance much earlier. If you need kids, 99.9% of the time, you're going to need life insurance. But, slide 10, don't ever buy life insurance for a child. Would you be devastated emotionally if your child dies? Oh, yeah! You want to rip out your lungs. Oh, my God, that's terrible. Who wants to bury a child? Yes, of course. But would you be devastated financially if your child dies? No. Excuse me for being callous, but you will be better off financially if your child dies. Don't ever buy life insurance for a child. Now, look, the benevolent machine bestows upon us wonderful things, but it also takes its toll. When your child is born, all these little red lights go on inside databases all over the world. There's another consumer into this world. And one of the first things they're going to do is start sending you, coupons for Pampers and the like. But they're also going to try to get you to buy life insurance for the child. And they'll tell you that it's acting as a savings vehicle. There's that uninformed. And sure, and they'll give you $20,000 if the child dies within 20 years or whatever. And then you can use the money to pay for 2 books in college. I mean, they're just really, really bad savings vehicles, folks. And it's just, they're not stupid. They know that the chances of a child dying, assuming it's in good health and born normal, whatever that means, it's just the odds are very, very low. So it's a license to print money. They're invisible bankers. Their doors are open. So don't ever buy life insurance for a child. But slide number 11, if you have children, oh yeah. Young married couples or single people with 1 or more children almost always need life insurance. Unless they've inherited this huge amount of money, they got a huge trust fund that they live off of. No. You need life insurance if you're one of us little people. The question for them is not, do we need it? Yeah, they need it. But rather, how much do we need? The answer to that is more than you think. And we'll discuss how much in a bit. So stick with us. It's not always easy task to determine how much you need. And don't forget the non-wage earner spouse. Normally, it makes sense to have some insurance on a non-wage earner spouse, stay-at-home mom or stay-at-home dad, to have enough to pay off the debts and replace the services for the non-wage earner provided. Now, there's a caveat to this because of how our society works and the battle of the sexes and the like. Because men, especially men who are fathers and the mother passes away, will usually remarry quickly. In the Bible, you used to take the sister. Right? You used to take the sister as your spouse. Women typically don't. Women go, okay, I'm already raising 2 children, and I was raising my husband as a child. Been there, done that, no more. And so this is what the sociologists tell us. This is a ranking. And I'm going to tell you that it is a little bit coarse, but it's what the sociologists tell us. These are the happiest people, married men. These are the most unhappiest people, single men. The single men say, but we... the single say, they might profess to be happier because they go carousing, but the sociologists say that the married men are the happiest, the single men are the unhappiest. The next group of happiest people are single women. And then the third, the second most unhappiest are married women. And so, every situation, of course, is different. But in general, married men are happier. They live longer. And the single men will say, well, it just seems that way. Do you want to live forever? Yeah, get married. Every day will seem like an eternity. And the single women, especially if they're lost their husband, say, okay, I can survive. Assuming the husband has been insured for enough money to pay the family going forward. So remember that the men usually remarry within 1 or 2, 3 years, especially if they have kids, where women say, no thanks, I'm done with with these guys. Be careful, men. Let's hope the women take over. I'm hoping for the women to take over, but we got to be kind to them, because they might take revenge on a lot of what we've done to them for over the last 4,000 years. Some examples. Slide 13. I digress. My apologies. Who needs life insurance? Does a young married couple with no children? Maybe, especially if they have a huge mortgage, but they don't have to worry about children, right? Assuming they both work. A young married couple, whoops, that was a mistake. A young married couple with 2 children? Oh yeah, this is the target market. This is the prime market. And if you get into the insurance industry and go with certain companies, they'll tell you these are the people who need life insurance. You need to find them. How about a single adult or an unmarried couple? Well, the single adult doesn't have children. No, they don't need it. The unmarried couple, well, it depends on how close they are, how much assets they have together. Specifically, what if they have a mortgage together? How about a single adult who is a partner in a business? Yeah, partnerships are similar to marriages. If one person passes away, the other partner or partners have to continue. And what happens to that person the partner who passed away? What happens to their share of the business? Their spouse, their children might inherit it. They might not want anything to do with the business. So often partners will have insurance on each other so that the business doesn't suffer if one of them passes away. How about a married couple with children, but both parents are high wage earners? They both make a very good salary. Do they need life insurance? Well, yes, if both of them were to pass away. And there are policies that pay only if both parents die within a certain period of time. And so they're very, very inexpensive, because it doesn't happen very often. But they have to think about that situation. Sure, if one of them passed away, the other could continue the lifestyle, could continue the financial duties of the family. But if both of them were to pass away, now we got a serious problem. So I think it's called second to die, I think it's called. And then the middle-aged couple with children gone and the house paid off. Yeah, they're done, right? This is the non-target market, but they still, insurance companies still go after them. They don't need life insurance. They are now self-insured, assuming they've taken our class and paid down debt and built up investments and the like. But what about that same middle-aged couple taking care of one or more of their aged parents? Uh-oh. Oh, yeah. This is a situation that's happening more and more, but the life insurance companies don't want you. Once you're in your 50s and 60s, go away. You want to be with us? Sure, we'll charge you an arm and a leg, and then half of the other arm and leg to get insurance. And that's a situation that people are looking at more and more here. So that's a difficult situation. How do you estimate your life insurance requirements? Well, there are various methods. Most all of them are pretty stupid, lame in my humble opinion. But the best one, of course, is from David Chiltern and the Wealthy Barber. Get out your financial statements. Remember them? Are they tacked onto your refrigerator? Use the net worth statement to total up your debts, especially if you have a mortgage. Start with at least this much so that the surviving spouse and family will be debt-free, or the surviving family if there's no other spouse. Create a second cash flow statement without the person's income and without the person being alive. You don't need 2 cell phones or 2 cars or whatever. This will tell you how much income the surviving family will need. Determine the principal needed to generate that income, and we'll learn about this later on when we get to investments. So you add the first amount, the debt, the second amount, the principal, to get how much life insurance you need. So it's not a trivial task, and we talk about it in the assignment sheet, and then we'll discuss different types of investments later on in the semester. By the way, a very simple rule is to just multiply 10 times your annual salary. So if you're making $50,000, you need $500,000. You're making $100,000, you need $1 million. That sounds daunting. However, if you're young, in decent health, and don't purchase the wrong life insurance, it's actually quite reasonable. It's actually very reasonable. We'll see. And when we do the assignment, and when we take a look at the 2 different types of insurance policies, and there's also a little presentation that shows you one company online that still shows you free quotes. The quotes are free, but they want you to put in your name and address and phone number and email, and then they contact you and try to sell you. But this one website, and there's probably a few others, and if anybody finds one, please let me know. We'll show you the quotes without asking for your contact information. So now, we said there are 2 types of policies, one with a savings component and one without a savings component. Right? Okay, so let's get started on the different types of insurance policies on slide 15. Term life, the only type of life. Payano, you just told me there were 2. Relax. Hang on a minute. We'll get around to the reason why there really is only one type of insurance. It's a protection. It's a policy with protection for a specified period of time. If you don't pay the premiums, boom, coverage stops. There's a renewability option, means that at the end of your term, you can renew the policy without having a physical. Well, typically, they want to convert you to a whole life policy without the physical. And if you're uninformed enough to actually buy a whole life policy in the first place, and you won't be by the end of our discussion, this is our brave hero! Yippee! Hooray! Term life. By term. No other. What about the other type? Slide 16. Well, it's typically called whole life. Well, it's also called straight life, ordinary life, cash value life, adjustable life, variable life, universal life, variable universal life. They keep changing the name. Why would they do something like that? Look, you pay a premium as long as you live. The amount of the premium depends on your age. When you start the policy, it provides death benefits, as that's the idea behind life insurance, and accumulates a cash value. You can borrow against the cash value or draw it out at retirement. But look very carefully at the rate of return your money earns. It is almost always abysmal. Like that word, abysmal? This is the evil villain. Boo. Wait a minute. Every 5 years or so, actually it's been now about 15 years, the insurance industry changes the name of whole life insurance. Why? Because eventually consumers get hit to how they're being screwed. To confuse the issue, they just change the name. Heaven forbid they stop selling the cursed things. The newest spin is permanent life insurance. Wouldn't you really rather have permanent whole life insurance instead of just temporary term life insurance? Well, let me ask you a question. Do you have permanent car insurance? How about permanent homeowners insurance? What's going on here? To review, there are 2 types of insurance, even though there's really only one type. Term life is a life insurance policy without a savings component, and whole life insurance is a life insurance policy with a savings component. Look, so what's the big deal, Payano? If the insurance company is offering to provide you with life insurance and a savings plan, why not let them? Here's a $500,000 term life policy for a 32-year-old male, preferred. Kids are 2 and 4. So they get a 20-year policy because in 20 years the kids will be 22 and 24. And it's $250 a year or less. I've seen them for less. If you went and tried to get that same $500,000 whole life policy for that 32-year-old male preferred, it would be $250 a month. $3,000 a year. You starting to see any difference here? If the company came up to you and said, this is again from David Chilton, thank you very much, sir. To save at our institution, you must buy life insurance. You must pay for it, even if you don't need it. We'll take everything you deposit in the first few years for ourselves. In future years, we'll charge you to deposit money into your savings account. You can borrow the money at any time, but we'll charge you interest on your own money. If you happen to die while this loan is outstanding, we'll decrease the amount we were to pay your beneficiaries by the outstanding amount of the loan. If you don't borrow from this account and you die, we'll pay the beneficiary the face amount of the policy and we'll keep your savings for ourselves. And finally, we don't offer the greatest rates of return, usually between 1 or 2%. See any difference yet? Slide 21. Insurance companies are regulated by the states. For the last 50, 60 years, virtually every insurance commissioner's office in every state has publicly stated that term life is a better deal for consumers than whole life. Virtually every consumers group recommends term life over whole life. How about now? Buy term and invest the difference. You see, he's understanding what this saying means now? You see, buy the term for $250 for the whole year, and then every other month, $250, put it in your savings plan, your investment plan. But Mr. Life Insurance salesperson will tell you, but with our whole life policy, you get forced savings. Most people don't have the discipline to buy term and invest the difference. Even with the best of intentions, they will not do it. Do you realize what they're saying? You are weak and helpless and stupid. Nonsense. If you have the discipline to make the payments to the life insurance company, surely you have the discipline to make the difference to your own savings or investment plan. So 1 month, you can pay it monthly, but they charge you an extra $1 or $2. If it's $20 a month or whatever. Pay the $250 to the life insurance company, and all the other months, pay the $250 to your own investment plan. I mean, it's just nonsense. But that's what they're going to tell you because they're going to want to sell you whole life. Why? What do you think? Hang on a minute. So do you see why we call term life insurance the only type of life insurance? It doesn't matter which type you buy. You are still paying for protection for your dependents in the event of your death. With term life, you're only paying for that protection. With whole life, you are paying far more for that protection. Plus, you are being tapped for an awful savings plan that you may not even get to use. Lastly, and the money pitch, if you do invest the difference, by the time you are nearing retirement, you will not need life insurance anymore. You will be self-insured. Now, there are some situations that we could come up with that are very unlikely, but could happen, that you would want life insurance when you're 50, 60, 70 years old. But they're just minuscule compared to the typical situation where a young couple or a single person has a child or children and they want to protect the next 20, 25, maybe 30 years because then the children are supposedly, or maybe not, but on their own and you are in your middle ages and you're ready for your retirement. Slide 24. Here's what I beat on the table. According to the 2023 American Council of Life Insurance Fact Book, Table 7.2, in 2022, there were 5.77 million whole life policies sold, where there were only 3.73 term life policies sold. What? Well, look, folks, remember that $500,000 policy? If you sold a term policy for that much, you'd probably make about $100 the first year, and then it goes down every year for the trailings, they call them. That's your commission. If you sold that $500,000 whole life policy the first year, you would get $1,500, and that would then start going down every year. You see where the incentives are? The life insurance agents want you to buy a whole life policy because their commissions are so generous. Whereas they don't really want to sell you a term life policy. There's pocket change compared to what they could get if they sold you the whole life policy. But here's where it gets bizarre. In 2022, the whole life policy insurance that was put into force was only $551 billion versus the term life policy that was sold 1.3. That should be million. I'm sorry. $1.3 billion of life insurance. What? Oh yeah, that's right. 551 billion, 1.3 billion. Right. 1.3 trillion. I apologize. I'm getting confused here. So wait, let's go back to this is review, but many more policies were sold of whole life, but far less insurance in force was placed because of the whole life policies, whereas even though they sold far fewer term life policies, far more insurance was put into force. Does this make sense, folks? The whole life policies typically were of less face value, whereas the term life policies typically were much higher, where a whole life policy might be $100,000 or $50,000. The term life policy might be $500,000 or $1 million. There was $1.3 trillion of term life issued, almost 2.5 times as much. And you might still be scratching your head and saying, I don't understand. Look, the number of whole life policies is far greater than the number of term life policies. Why? Mostly because life insurance salespersons get greater commissions from selling whole life. But the amount of insurance in force for term life is far greater than whole life. Because term life is far less expensive than whole life, you can buy the amount you actually need. So, after the insurance agent convinces the poor slob that she needs life insurance, the agent sells her far less insurance than she needs because the poor slob cannot afford to pay the huge premiums for the amount of insurance her family really needs. So, in other words, she really needs $500,000, but that's going to be $250 a month. So he sells her $100,000, and that's only $80 a month. But that's not what she needs. She needs I think you should be put in jail if you're an insurance agent and do this. It's like taking out somebody's appendix, and they don't need to be taking it out. You're doing something that's not in the best interest of your client. You're doing something that's in your best interest, and that to me is just horrible. Now, there's going to be some people say, well, there's some people who can afford they have to pay all the whole life policy. Great, if you're in that position and you have money to burn, go ahead, buy a whole life policy. I still think there's better things you can do with the money. Certainly, you'll be better off down the line. But for the vast majority of us working grunts just trying to scrape through, we need to protect our loved ones. We need to pay for the term life because we can afford the $500,000 or even $1 million of insurance. So go back over those two graphs, and I know it's a little confusing, but life insurance, and I get pushback. Don't think remember I'm a life insurance agent. I get pushback from other life insurance agents who tell me, what does it matter with you? You know, what happens when they're 50, 60 years old and they still need life insurance? I said, well, that's, first of all, very rare. And second of all, if they did do a proper investment program, they wouldn't need the life insurance. They would be self-insured. So I get you will hear differently from other individuals. So there are some other types of life insurance that you might be offered. And certainly if it's free, it's a good deal. Group life, it's almost always it's term life. And it's usually provided by an employer or professional association. Usually a very good deal, especially if it's free. For example, Southwestern College employees used to get 25, I think now we get 50. Your credit union will usually give you 1,000. Whoopee. Why do they do that? Well, they don't actually do it. Some insurance company goes to the credit union and says, "Hey, we'll give you all your members $1,000 if you give us their uh, contact information, and we can use your name and say we're sending this to you on behalf of Mission Federal and Navy Federal, and then we'll try to sell them. We'll try to upsell them more life insurance, usually at a very expensive term policy." Don't buy credit life insurance. It's very expensive and it protects the lenders. Make sure you stay away from credit life insurance. Go back over it and buy the term life insurance and look at your debts and the process that we talked about. Now, these are really stupid. Accidental death. Do you care how a person dies? If they're dead, they're dead. So you get these accidental death or double indemnity things if you lose a leg or whatever. Can you? They're cheap. Sure, they're cheap because but you get the phone call. Oh, he's dead. How sad. How did he die? Motorcycle. Oh, good. I mean, no bad. Don't buy accidental life. Yeah, and it's often really expensive too. Sometimes it's cheap. Sometimes it's really expensive. You can get the same amount of coverage with term life, no matter how the person dies, whether it's medical or whatever. Okay, let's take a look at some of the We're in the home stretch, folks. I'm sorry if I've been burbling on for quite some time, but this is important stuff. Which life insurance policy you buy? Contract provisions. You have to name your beneficiary, contingent beneficiaries, update it when necessary. Example, divorce. Okay, make sure these are estate planning ideas that we'll talk about in Chapter 6. The suicide clause says, look, if you commit suicide within the first 2 years, we're not going to pay the amount. This is to keep people who, I'm not a psychiatrist, but my understanding is if you're contemplating suicide, you have mental health issues. Somebody might have, their business might have failed or whatever, and so they're going to take care of I'm going to take care of my family by committing suicide. Don't do it, all right? But after 2 years, 3 years, they figure, okay, he or she wasn't mentally ill when they bought the policy, but now, okay. Don't lie about your age because they won't pay the amount. They'll pay back the premiums to the beneficiaries, but in both cases of the suicide clause or the misstatement of age. But don't lie. Now, if you have a life-threatening or life-ending illness, and I think you have to talk to a doctor or whatever. What's going on here? Okay, there. I want to see that at the bottom. You can get what's called an accelerated benefit or a viatical settlement, and these were very popular back in the 1980s and early 90s when many people were dying of AIDS. And so they had a life insurance policy, and they could pull from the life insurance policy while they're still living to help them with their end-of-life issues. If one of the cool things that insurance companies typically will give you is a waiver of premium. If you become disabled, they'll say, okay, you don't have to pay us the premium anymore. The loan provision is part of the whole life policies for uninformed people. Premiums paid from cash value. Oh, I forgot to show you the whole life policy. I'm going to show you the whole life policy in a minute. And then some insurance companies say, well, if we can't sell them whole life, at least we can sell them term life and tell them, hey, you're going to pay these premiums over the next 20 years. And what if you don't die? Oh, what a bummer deal that would be. No, it'd be a good deal. You don't die prematurely. We'll return the principal to you. Well, you're going to pay a whole lot more. And basically, it's a savings plan inside the life insurance policy. And they're hoping to, assuming you don't die, invest that amount and have something left over after you don't die and pay back the amount. And of course, if you do die, they don't pay back any of the principals. So I don't think these are a good deal. Okay, now, how about you're choosing your insurance agent? Well, there's a saying in the industry. Life insurance is sold, not bought. Right, they're going to try to sell you a whole life policy. Get a good referral. Is the person willing to take the time to answer your questions and find a policy that's right for you? Are they available when needed? Do they ask you about your financial plan? Do you feel pressured? And most importantly, are they still trying to sell you the whole life when you already told them 3 times that you want term life? Kick them in the butt as you slam the door. Okay. Be careful. Can't let my blood pressure get too high. Yeah, get a good agent. Get a good referral. Because if they're still trying to sell you whole life, they don't care about you. They're only caring about their boat payment. How do you get the policy? Well, you got to apply. Most individual policies are going to ask for your medical history. They're going to usually get you on the scale. They're going to look at your blood pressure, get you on the treadmill, read every word of the contract. And after you buy it, you have 10 days to change your mind. Now, what's this all about? Well, politics. People get screwed by these whole life policies, and then they go to their elected representatives and say, why are these things allowed to be sold? I can't believe I was screwed by these. My mother passed away, and she only had $100,000. She needed $500,000. They sold her the whole life policy. So the legislature says, what are we going to do about this? And the life insurance company says, well, you don't want to limit people who could, the 0.01% of people who could actually afford the whole life policy that they need and don't really care about how much money they spend. So this is what we'll do. We suggest that you give people 10 days to read the policy and change their mind. Yeah. It's politics, folks. Give your beneficiaries. What is it? I mean, it's nothing new. Mark Twain, over 100 years ago, said we have the best Congress money can buy. Ugh. Give your beneficiaries and your lawyers a photocopy because they gotta know where it is. This is part of estate planning. What are the settlement options? How do you take the money? The most common option is the lump sum, and it's almost always the best choice. But remember, insurance companies are invisible bankers. We can pay you a specified amount over the next 20 years in equal installments. We can create a life income option, an annuity. Oh, more about annuities later when we get to investments. Or, hey, we're life insurance companies. You can leave the proceeds with us. We'll pay you interest, and you can take it out like you take it out of a savings plan in a bank. Look, folks. Slide 32. No matter what the life insurance company says, take the lump sum and invest it. If you're the beneficiary, if you're the insured, you're dead, right? Leave a letter of instruction if you're the insured. By the end of this class, you will have a rudimentary knowledge of investments that will give you a rate of return that is at least 2 to 5 times better than anything the life insurance company will offer you. This is their business. They know. They prey upon the surviving spouse. Oh, ho, ho, little lady, it's often a woman, and they patriarchally say, we'll give you an income for the rest of your life. We'll screw you for the rest. No. We'll set up an annuity that'll make sure it pays you an abysmal, it's a certain amount for the rest of your life. Yeah, we'll thwack annuities later. Remember, I'm an insurance agent, but don't worry, we're going to insult everybody. Wait till we get to stockbrokers. Slide number 33. Should you switch policies? The answer is usually no, unless it's a term policy where the benefits exceed the cost of getting another physical and paying the policy setup costs. Are you still insurable is the big issue. Look, if you see you get this really great deal, it's $25 a month, and then you see this other one that's $20 a month, don't cancel the old policy until the new policy is in force. Make sure you've made the payments and it's been a month or two and they haven't come back and said, oh my goodness, we just found out that you have hepatitis B. Yeah. But normally you're just not going to be bothered. You're happy with the $22 a month or whatever it is if you're 30 years old or 25. Normally the only reason people switch whole life policies is because a life insurance person convinced them to switch. Why do they want them to switch? Because if they were uninformed enough to buy a whole life policy in the first place, they're probably still uninformed enough to switch to another policy. And the salesperson gets a ton of new commissions. Several years ago, a few insurance companies got into hot water. We won't name any names. Nationwide, Prudential, for pushing elderly folks to switch policies. And it's not the company, folks, it's the agent. And there's just a few bad apples that give all of us a bad name. I remember, I can't find the article, it's been taken down, but this guy, somewhere in the South, I think Atlanta area, had gotten an elderly woman to just switch policies. It's either 14 or 40 times. I remember 40, but it can't be 40 times. I mean, she's switching a policy every year. No, it's criminal. And the guy didn't go to jail. They had to make restitution to the woman. He lost his license forever, but still, they're out there, and they give all of us in the industry a bad name. So do be careful. Okay, the bottom line. So now do you understand what buy term and invest the difference is? Now do you understand that? I hope so. And I didn't show you the whole life policy, and there's a presentation that goes through it, but let me show it to you here. This is an actual whole life policy that a client of mine asked me about. He was about 20 years into the policy. He was paying $60 a month, and at the end of 30 years, he would have the cash. He would have $17,551 in his policy. So after $60 a month for 30 years, which by the way is over $21,000, he would have a grand total of $17,551 in his policy. He was about here. He said, "What should I do?" I said, "Well, I would stop paying it. It's up to you." Now, be careful. If you stop paying it and don't cancel the contract, what they're going to do is they're going to start using this amount to pay the principals in the future. Oh, you don't want your policy to lapse, so we'll take the money that is in your account and start paying them for you. It's, as the Republicans like to say, buyer beware. Caveat emptor. So you got it. We're going to end on a fairly positive note because you're going to see in the ancillary presentation where I go into lifeinsure.com and check out the current prices for term life versus universal life. They won't show you a whole life policy. They want you to put in your contact information, and then they're going to have insurance agents come after you to try to sell you whole life. So you're going to see the huge difference. So you are now a much better financial guru for your friends and family and coworkers because you will help them stay away from whole life policies. And again, very last time, there are a scant few people for whom a whole life policy might make sense because they got all these other investments. They got tons of money to invest. They don't have to worry about anything. So go ahead, buy a whole life policy. It's probably not going to be the best investment you could do with your money, but they're out there, and they're the exception that proves the rule. Thank you so much for being in our class, dear students. None of my students are going to be duped into buying these overpriced savings vehicles inside life insurance policies. Thank you so much for being in our class.